everybody, and welcome to another episode of the Trusted Trustee podcast. And as usual, I've been joined by Tracey Besters in the beautiful Southern Highlands of New South Wales. Hi, Tracey, how are you going?
I'm great, Darin, and thanks for having me. And it is a beautiful day today, a little bit overcast, but at least it's not too cold yet. So that's a good thing.
Very, very good. And of course, this podcast is brought to you by Superfund Property Valuations. Take the tension out of tax time by making Superfund Property Valuations your number one choice for all of your SMSF property valuation requirements. With compliance becoming more important than ever, you need the team with a 100% track record of auditor and ATO satisfaction. Their service is tailored for SMSFs to provide market-leading turnaround times and prices. Order a report today by filling in your details on the online form at superfundpropertyvaluations.com.au and let Superfund Property Valuations take care of the hard work. And as I always say, valuations are extremely important, and actually we are going to actually touch on that subject a little bit during our discussion today. But on to what we're actually discussing today, and it's kind of like a bit of a follow-up from the last episode where we spoke about related party transactions. We're going to talk about the in-house asset rules for SMSS. And these are kind of rules that you want to steer clear of. They're not catastrophic, but it's probably better not to fall foul of them. But you can manage them even if you do have a bit of a problem there. So let's kick it off, Tracey. What are the related party rules?
Yeah, so Darin, last episode we drew on your wall, remember, and we had that big
Yes.
diagram of everyone who's related to you. So, and the reason we wanted to spend time on that last episode is because it would help to make this episode and this topic make more sense, I guess. So we're talking about in-house assets, and way back in August 1999. So August 1999 was probably my
Wow.
first foray into SMSF world, Darin. So, almost 26 years ago, and that makes me feel a little weary, but 26 years ago, the government wanted to change some of the rules around what can an SMSF invest in, and what can that connection be with a related party. And part of the reason they wanted to do that was, and I'm quoting what the government said at the time here, they said to ensure the investment practices of superannuation funds are consistent with the government's retirement income policy. So we're kind of still talking about the government's retirement income policy 26 years later, aren't we? With the objective of superannuation. So
Certainly
nothing
are.
changed. So, and the whole point of the government's point back then, I guess, is that superannuation savings should be invested prudently, consistent with the SIS requirements for the purposes of providing retirement income and not for providing current day benefits. So if we kind of take a step back to what we call our pre-99 unit trust. So related parties, and SMSF could invest in those related parties, and those unit trusts could do pretty much anything. They could borrow money, they could invest in other things. They're kind of like the golden child of the SMSF related party world. And to this day, I have clients that still have pre-99 unit trusts. So we've got some pretty cool things that we can do there. But the government changed those rules, and then they introduced this whole concept of restricting how much can be part of the SMSF in these in-house asset arrangements or with these related parties. So they introduced a couple of things into the SIS legislation and brought in this definition of what an in-house asset is. So an in-house asset effectively is something that the SMSF invests in after 11th of August 99, hence that magic date, 11th of August 99, and it's an investment in, a loan to, or a lease to a related party. So the first thing we've got to do is understand what our related party or who our related parties are, which we did in the last episode. And then now we have to look at, well, if we have a connection between our super fund and this related party, is that going to fit within the definition of an in-house asset? So it kind of connects that way.
Yeah, a very good explanation on the surface, but as usual, there are lots of intricacies, underneath the surface of the pond.
Yeah.
One of the characteristics of the in-house asset rules is this 5% limit in regards
Yeah.
to the total value of the SMSS assets. How does that work?
Yeah, great question, Darin. So the government are not saying that you can't have an in-house asset with your SMSF, but they are saying that if you do have an in-house asset, so if you have a loan to or an investment in a related party or a lease of an asset to a related party, then you've got some limits around what the total, what that looks like. So we can basically have under the 5% rule, colloquial 5% rule, but the ATO actually do refer it as the 5% rule. So we're taking ATO terminology here. That means that you can have up to 5% of your total assets of your super fund invested in this in-house asset. So only up to 5%. So $1 million fund means we can have $50,000 max as an in-house asset. And if we go over that, we've got some problems. But if we keep under that, then we're okay from an in-house asset perspective. That doesn't mean that we're okay under other provisions of the superannuation laws, but just as an in-house asset, we're okay under that 5% limit.
Now, that's obviously a hard limit, and probably people out there are thinking, oh, well, that's pretty easy to manage. It's 5%, 5%, whatever. But as we know, with not just SMSS, but in the investment world, it is a constantly changing dynamic. The value of
Yeah.
what my share portfolio today will not be exactly the same value as what it will be tomorrow. So
Yeah.
with that dynamic, and this has got absolutely nothing to do with the in-house asset itself, more to do with the adjustment of or the fluid nature of the 5%.
Yeah.
Look, what happens if the rest of your portfolio or your investment portfolio fluctuates? So that 5% goes up and down, and you find yourself, well, I thought everything was sweet when I put this together, but it turns
Mm.
out now that my in-house asset has actually gone to 7% simply because there's been a drop in the ASX, um,
Yeah.
and my portfolio is not worth what it was when I did the in-house asset.
Yeah, that's a great question, Darin. And this in-house asset test, this 5% test or the 5% rule is an assessment at 30 June each year. So we have to look at what does our balance sheet look like? What are our total asset valuations? And that's why valuations are so important to get right. What does our valuation look like at 30 June, total asset? How's our in-house asset percentage looking? And if we're below 5%, we're good, or if we're up to 5%, we're good. If we go over that 5% mark, then we have to rectify. So we're basically given some time, which is a good thing, right? So the ATO say, or the government say, you can have some time. You can have up to 12 months to deal with this because, rightly, you can't control the market. So we can't just say, well, the market's going to change, so therefore we're fine. So we do have some time to fix up our 5% issue. And mostly you would think, well, the only way I can fix up the 5% is to actually sell the asset or sell part of the asset to get me below the 5%. And in some situations, that is the case. Sometimes you have to sell, but you then have to think about, okay, what other strategies do I have that I can actually help to influence, if you like, this 5% rule by increasing the total asset value of my SMSF. And so those are some of the strategies that you would work towards to be able to increase that. So that's basically where we're at. At 30 June, what does it look like? How close are we to that 5%? And this is why you probably don't want to be kind of tinkering at that 5% all the way through, because if something happens and we can't control it, then you've got limited ways of being able to deal with it. But if you're only at 2 or 3%, then you've got room to move.
Yeah, a couple of great points there. There's absolutely no need to stress yourself out to max out the in-house asset limit when you're
Yeah.
doing this. I mean, obviously, sometimes it can't be helped because you're talking about a particular arrangement, which means that,
Yeah.
well, maybe I have to be on that limit because I need to use all of the leeway possible. But you're right, it's prudent, obviously, not to take it to it's like maxing out your credit card, isn't it? It's not prudent to really max out your credit card all the time, even though the facility's there for you to do. But
Yeah.
I think you raise a great point. And I don't know whether or not you describe this as being contrarian in its nature, but you're right. If you have a moment like that, I think the mind immediately jumps to, okay, so to get, to get it back to 5%, I've got to, what can I sell? But
Mm.
you're absolutely right. Looking at it from the other perspective, a contribution strategy can be just as powerful because particularly if the market has experienced a dip, why not contribute more money into your SMSF at that time to maybe pick
Mhm.
up some cheaper shares
Yeah.
and boost it back up to the 5%? It's not always in the or in our psyche as human beings, because I think our
Yeah.
knee-jerk reaction always would be, oh, so what can I so what can I sell off to manage this
Yeah.
situation? But it doesn't always have
Yeah.
to be like that. And in fact, that can actually be a positive outcome in managing this exercise than,
Yes.
no, I have to sell this, you know?
Yeah, 100%, Darin. And I think, if you've got to, because if you needed to sell, what you actually have to sell is the in-house asset. You've got to actually get the in-house asset down, right? So that's not always going to be possible. You might not be able to sell that in-house asset on an open market, for example, or it might have other ramifications and impacts on perhaps your business operations if it's something that is, if it's a piece of machinery that you're leasing to your business, then who are you selling that piece of machinery to? You can't just go and I can't sell my machinery to you, Darin. That's not going to work because that will impact my business operations. So, and this is this whole concept of the government saying, well, this is not for present day benefits. This is for future retirement benefits. And hence the reason they brought all of these rules in. So, but some of the strategies, contribution strategies of managing in-house assets, absolutely. And I think this is a great segue to where we're going with the podcast in the next few episodes around planning for year end, because you cannot leave, and I think I've said this before, please be kind to your accountants and advisors. You cannot leave these discussions to the last week of June to have a look at what's going to be the end result of your SMSF total assets. If you've got an in-house asset situation in your SMSFs, then you need to be working with your advisors and with your accountants now in the lead up to end of financial year to make sure that we're not going to have these in-house asset problems. So one of the things we need to be looking at is, do we have any ability to make contributions? Can we get more money into the SMSF? And of course, that's going to then depend on, a total super balance. And do we have any capacity under the contribution caps to get more money in? Can we use a downsizer contribution? Can we, look at a bring forward non-concessional contribution? Do we have any catch-up concessional space left in our caps? What can we actually do to get more money in? Do we need to bring someone else in? Do we need to actually have someone else as a member of the SMSF to roll over a balance to boost the total assets of the SMSF? That's another option. Not my preferred, but that is an option. So do we, what do we need to do market valuation wise? If we've got an uplift in our market valuations, then, is that going to help with our 5% limit? If we've got a downturn, then this is where we need to actually start thinking about other strategies. And one of those other strategies, Darin, might be that if we're taking more than the minimum pension, maybe we delay that until after 30 June. Because then we've left more money or more asset value in the SMSF to help with this 5% threshold.
Yeah, you raise a really good point. There's obviously more than one way to skin a cat, as they say in the classics,
Yeah.
when you have to deal with a situation like this. Now, if you are faced with this situation, do you actually have to come up with a written plan as to how you are going to manage it? Like, is there anything
Yeah.
sort of set in stone that you say, okay, I've identified this, this is how I'm going forward with the strategy to address this, and this will be the result to bring me back into a complying situation with the in-house asset rules?
Yeah, you do, Darin. So you do actually have to formulate a plan. You do have to formulate a written plan and an action plan as to what you're going to do. So as much as the regulator, the ATO, is very kind to us and gives us 12 months to deal with it, it's not like go on your merry way, just make sure, blah, blah, blah. Like there are some steps that you need to go through. And if you come up with a written plan, and let's say that you put everything in place and you do everything possible to formulate that plan, but something happens outside of your control, then, there are some avenues to be able to deal with the regulator in those circumstances as well. But if you make no effort to deal with it, you just, head in the sand, don't care, not my problem, rah, 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 whatever, whatever. It's my accountant's problem, not mine. Then, there are some consequences and you are going to breach Section 82 or Section 83 of the SIS Act, which means that you've got those compliance penalties. And so it's going to cost you thousands and thousands and tens of thousands potentially of dollars if you don't get it sorted. So you've got time, which is a great thing. You do need to have a written plan. You've got to have some sort of formulated action that you're going to come up with to be able to fix this 5% in-house asset. And if all else fails, then you are going to have to sell that in-house asset. So then you've got to think about what are the circumstances and consequences or ramifications, if you like, of the SMSF having to sell that in-house asset, things such as stamp duty, depending on the state, capital gains tax, etc., liquidity of having to sell that particular in-house asset out of the fund. So the higher or the closer you are to that 5% limit, as I said before, the more difficult I think it is to be able to manage. But 5% is not much, Darin. Like you've got to have $1 million fund to even get a $50,000 in-house asset there in the first place. So we're not talking about high amounts of money, but the ramifications of getting it wrong and the consequences of not dealing with it can actually be quite costly to the SMSF in light of the proportion of the penalty versus the dollar value of the in-house asset to start with.
Yeah, I think it's really important to note that you have to put a plan in place and you actually have to formally deal with the situation. I know that I laid out a scenario earlier on to say that because of market fluctuations, this is where you could get into a little bit of difficulty if you maxed out to the 5% limit,
Yeah.
that one small negative market movement can actually put you in danger of going over that 5% limit. But
Yeah.
that's not to say that you can apply the logic of, oh, well, Tracey, that's okay. There's market fluctuations all the time, Okay, I came out on the wrong side of it this time around, but in 12 months' time, the market will have bounced back. My 5% won't be an issue. So fingers crossed, let's just move on. You cannot do that. The ATO will jump on you if you do that because
Yeah.
while, as you say, they are a little bit generous and understanding, I suppose, in the way that these situations have to be managed and how much time that takes. If you don't do anything and just keep your fingers crossed, that ain't going to get you a favorable outcome with the regulator, that's for sure.
No, exactly, Darin. And also remember that Section 82 is our major in-house asset piece of legislation in the superannuation laws. So that's where we've got the limit of the 5%. But Section 83 actually also, piggybacks on that and says that the SMSF can't acquire an in-house asset if we're going to exceed the 5%. If it's already exceeded or will exceed. So you can't also then say, well, we're in April now. You can't say, well, okay, I'm going to acquire this in-house asset now, knowing that it's going to exceed the 5%. And hope that my other values kind of increase to bring me back below. You can't actually purposely go and increase or exceed the 5% because then you'd be breaching Section 83. So you've got to be careful that I think that there's a lot of intention behind these rules, Darin, and so that the intention of the trustees in what they do and how they acquire these assets, and whether they are purposely trying to manipulate this 5%, it really becomes part of the whole discussion because we can't just go, oops, we didn't mean to do that. And yes, there are lots of circumstances in the market outside of our control. And I'm not saying that part of it is completely understandable, but where you've purposely gone and increased your asset purchase or your investment in or your loan to, you have to be really careful. So it kind of begs the question, why would you do it in an SMSF? And, the catchphrase that we've said many times, just because you can do it doesn't mean that you should, that really kind of hones in on this in-house asset discussion.
Yeah, 100%. And the ATO is also red hot I mean, they may not be looking at it from an in-house asset perspective, but they are red hot on, if they perceive that the trustees are doing something for a scheme, not necessarily
Yeah,
a tax avoidance scheme, but a scheme of any sort that would not really be in the true spirit. Normally, it's to do with the sole purpose test, but in the
yeah,
true spirit of running a super fund, they're going to be on you. I mean, that's a
yeah.
big thing for the ATO is to kind of weed out this rule manipulation that people think that, oh, this is allowable in an SMSF. Hey, we can do
Mm,
this. How can we make this
mm,
work to our advantage? Well, of course you can make the rules work to your advantage, but you
yeah.
can't do it in a way that it's so blatantly obvious that you're just trying to manipulate the situation,
Yeah,
because you will get caught out. Now, one
yeah,
thing I did want to raise, I mean, we've talked about a very sort of surface level um, application of the in-house asset rules, but these are actually quite tricky in practice. I know I've been
yeah,
to a lot of presentations when they talk about SMSS investing in unit trusts, and it
yeah.
and it may be a trust where a distribution has to be made every year.
Yes.
Now, I know this is a little bit off the track. You might find this is a little bit off the track. How the hell is this? Is this linked? But
Yeah.
it can be as tricky as if the trust doesn't actually pay out the distribution for whatever reason,
Mm, mm.
for that particular year, that can be perceived as
Mhm.
financial assistance or
Yeah,
the SMSF making a loan to that unit trust. And guess
yeah,
what?
that's right.
That becomes an in-house asset.
Okay. Yeah, it does. You're right, Darren. And it's not necessarily just an in-house asset as well. That could be a breach of providing financial assistance as well.
Yes.
So, because remember, these rules don't just, they're not like, we don't have blinkers on and we just look at one rule in the SMSF space. We're
Yeah.
looking at this rule plus that rule plus that rule plus that rule. We're looking at all of them. It's all encompassing. So, absolutely, if you've got, there are some exceptions to the in-house assets rules when we talk about unit trust. So if you've got an ungeared unit trust, so the unit trust doesn't have any borrowings, it doesn't run a business, it doesn't invest in anything else apart from cash or property. It doesn't have any shares in another organization, et cetera, et cetera. There's a whole lot of rules, and that we call those colloquially the Reg 1322C trusts or companies. So you can that is an exception, a specific exception from the in-house asset. So if you can tick all of those boxes with that particular unit trust investment, then that won't be an in-house asset. But you've also then got to be careful, like you say, Darin, around the distributions from those trusts. So the distributions must be paid out before 30 June, or as soon as practical, really, to be paid out from those unit trusts, because otherwise we do then have this other asset that sits on the balance sheet of the super fund to say, wait a second, you owe me some money. And if you owe me some money, then have I given you a loan? Have I provided that financial accommodation to a related party? And therefore, we have this whole in-house asset issue across the board there as well. So, really, when you're thinking about structuring in the SMSF, explore all of the options, but make sure that you've got liquidity sorted, make sure that you've got an exit strategy sorted, and make sure that you've really thought about, is this, what's your plan B? Is this really going to be manageable now when we look at getting into it, but also manageable over the years as asset grows and asset values grow or change, and the whole makeup of the SMSF balance sheet can change, because you could just find yourself in this situation. Yeah, you've got this funky strategy now, but in 5 years' time, we've now got this nightmare on our hands
Yeah.
because we can't manage it anymore. We've got a monster that we can't
Yeah.
manage anymore.
Yeah.
So it's just about, what's the exit and what's the liquidity look like. And I talk about that when I'm talking about any particular type of strategy the SMSF is doing, because you've really got to think about that plan B, plan C, plan D, plan E, plan F, how many plans you want to have, but you've got to think about your options.
Yeah. 100%. It's like the Formula One teams where they go, let's go to plan B now or plan C. Of course, they're doing it while they're driving at 300 Ks an hour, which is not something that you have to do in an SMSF, but it's important to strategize and have fallback positions so that you can manage situations that you might not have foreseen, obviously, at the time of putting together the original transaction. Now, just in
Yeah.
the last
Sometimes I feel like my mind's going at 300 kilometers an hour, Darin, when I'm talking about this stuff. So does that count?
Yeah, I'm with you, Tracey. Everything in the SMSF world for me seems like it's going at 300 Ks an hour. So, absolutely. Now, just in the last few minutes, do you have any sort of war stories or examples that you'd like to
Yeah.
share with us with regard to
Absolutely.
trustees who have found themselves with having to deal with in-house assets?
Yeah, for sure. So I do have a war story where we had to unwind a unit trust because we had a breach of the Reg 1322C rules. So remember I said before that where you've got an SMSF that's invested in a unit trust that doesn't have any borrowings and meets all of the requirements, then that is excluded from the in-house asset rule. So it doesn't count towards the 5% rule at all. It's completely excluded. So we had a situation a few years ago where the clients overdrew. They had an overdrawn bank account in the unit trust, and so that kind of is alarm bells because is an overdraft a borrowing, and so that whole. And it was for an extended period of time. So they didn't seek advice through the year. So we got to the end of the year in about May and talking about tax planning. And we discovered for that about 6 months of the year, they had an overdraft bank account in the unit trust. So that meant that we breached the exception rules. We breached the rules for this, this ungeared related unit trust requirements because we now have a borrowing. So therefore it's now not excluded from the in-house asset test. And of course, anything that has property in it is going to be really hard to meet the 5% rule, Darin. So any property, remember I said $1 million SMSF, you can have $50,000 of in-house assets. Not too many $50,000 properties around these days, right? So
No.
that meant we totally exceeded the 5% rule, and we literally had to undo the whole of the related trust. So that meant stamp duty implications. It meant a whole lot of other cash flow implications as well. So it just became a nightmare. And it could have been easily avoided if the unit trust bank account didn't become overdrawn. So, that's one example. The other examples, I probably would have had more war stories if we had Div 296 in play from 1 July, because I would have been having to deal with a whole lot of, managing, Div 296 balances. So that would have been a problem. But I guess one of the things is making sure if you've got any of these kind of more left field investments, work with your accountants and advisors to not have a situation like I had with my clients a few years ago where it was kind of, there's nothing I can do. There's nothing I can help with to help that situation. So yeah.
Yeah,
Awesome.
and you raise a really good point there too, Tracey, is that very often we look at these rules and we look through a prism of the way the ATO views it. And of course, that's important because we are talking about compliance issues.
Yeah.
But the penalties and, the disadvantageous position the trustees might find themselves in does not necessarily stem from any punitive action the ATO might impose
Yeah.
on you. Just by
Yeah.
having to manage the situation out can trigger, as you said, stamp duty issues. It could trigger capital gains tax issues.
Yeah.
There are
Yeah.
all of these peripheral issues, which has absolutely nothing to do with the ATO being the regulator of the SMSF,
No.
but their circumstances, you don't want to put yourself to have to suffer those consequences, do you?
Yeah, exactly. And also, Darin, I think one of the examples that the ATO use in their ruling around their SMSF ruling around in-house assets is where you've got kind of a piece of machinery. So the SMSF owns a piece of machinery and it's it's housed in and used by a related party business. And the example that the ATO give is that there was no formal rent paid for this machinery. So at face value, say, well, I'm not leasing it, I'm not renting it because I'm not paying any money. There's no exchange of consideration here. But just because you don't have a formal arrangement in place doesn't mean that it still won't be classified as an in-house asset. So just be careful of things that look at face value like it's not a formal arrangement. It's not it's not sort of something I've got a legal documentation around, even though you should have documentation. The ATO can still look through all of that and say, well, how are the parties acting? What is the situation between these parties? And if the SMSF owns an asset and it's being used by a related party in whatever capacity that looks like, then chances are it's going to be an in-house asset. And that chances are then you have to then make sure that you meet all of these requirements around the in-house asset rules. Otherwise, you're going to have a breach on your hand. And like you said, you can't just stick your head in the sand and just, cross your fingers and hope that that's a strategy to be able to deal with it, because it's not.
No, no. And on that note, it's time to wrap it all up, Tracey. So, look, thanks for your time and thanks for the discussion about in-house assets. I think it's been really good and really informative.
Thanks, Darin. And I look forward to the next few episodes around planning for year end. So every single SMSF trustee should be starting to think about the year end. We've got like 3 months to go. So now's the time to start looking at the things that you must do for year end, the things that you should do for year end, and the things that you could do for year end.
Yeah,
So that'll be
very,
our next
very
year.
important in the lead up to 30 June.
Yeah.
Thanks also to Superfund Property Valuations for their support. Thanks very much to my production team for putting this together and obviously posting it on the relevant channels, as will happen in subsequent days. But most of all, thanks for your company and for joining us for this episode of the Trusted Trustee podcast. And we look forward to you joining us again next time we put together an episode of the podcast. See you then and have a great day.
Thanks. Bye for now.